Okay, so we've been digging into this stack of documents from Cyient DLM Q2 FY26.
Right.
And it's fascinating, right? You see this big structural shift happening in high-tech manufacturing.
Definitely. And this company's right in the middle of it.
But the numbers, they present this real paradox, almost confusing at first glance.
They really do. If you just looked at, say, the revenue, you'd get one story.
A pretty alarming story, maybe.
Yeah. But then you see the profit headlines, and they look, well, fantastic.
Spectacular, even.
And that's, what we really need to unpack today. How do those two things coexist? And more importantly, what's the underlying strategy? Especially this pivot towards build-to-spec or B2S.
Right. That seems key to their future. So our mission here is to dive into that core strategy, looking for that quality of revenue they mentioned.
Exactly. We'll look at where the profit actually came from, how diversification is helping margins now, and what this big order book means for, say, the next 5 years.
Okay, let's start with that big contradiction then, the one that just jumps off the page.
Please do. It really sets the stage.
All right. So Q2 revenue. INR 3,106 million. That's Indian rupees, of course. And that's down sharply, like 20.2% compared to last year, a big volume drop.
A very significant drop, yeah.
But then the reported net profit, the PAT, it's skyrockets,
Yeah.
up 108% year over year, hits INR 321 million. How do you even square that? Sales down 20%, profit double.
Yeah, see, this is where you absolutely have to look beyond the headlines. It's interesting, right?
Very.
That huge jump in the reported PAT. It's got almost nothing to do with selling more widgets or running the factory better this quarter.
Okay, so what is it then?
It's basically an accounting event, a one-time extraordinary gain. Think of it like finding money you thought you owed someone, but turns out you don't.
Like canceling the debt.
Exactly. It relates to an acquisition they made, a company called Alltech, about a year ago.
Okay.
Part of that deal involved what's called an earn-out liability, basically a promise of extra payment to the sellers if Alltech hits certain performance targets.
And I'm guessing they didn't hit them.
Precisely. The conditions weren't met this quarter. So that potential payout, that liability on their books, poof, it gets reversed. And that reversal flows straight through to the profit line.
So it's like found money boosting the reported profit, not actual operational improvement.
You got it. Clean, perfectly legal accounting, but it's not operational profit growth.
Okay, so if we want the real picture, we need to strip that out. What's the actual operational profit look like?
Right. We look at the normalized pay, and that was INR 126 million.
Which is?
Still down, actually. About 18.7% lower than last year. So operationally, the profit did follow the revenue down. The volume story holds.
Right, the volume story is tough. Makes sense, especially if they finished a big order.
They did. A large multi-year defense order concluded, which explains a lot of that revenue dip. But here's the other side of the coin, and maybe the more important part.
Okay.
Even with that lower volume, look at their EBITDA margin. It hit 10.0%, double digits.
In manufacturing, double-digit EBITDA is pretty healthy.
It is. And crucially, that margin is up 192 basis points year over year, almost 2 full percentage points better.
Wow. Okay, so less revenue, but each rupee of that revenue is significantly more profitable.
Exactly. That signals real operational strength, doesn't it?
Yeah.
They managed to protect and even grow their margins despite losing volume.
How? Better product mix. Efficiencies.
Both. Management specifically pointed to an improved mix, selling more profitable things, and better supply chain management. They use the phrase quality of revenue. They're consciously doing less of the low-margin stuff.
So less work, but better paid work.
That's the idea. And it shows up in cash flow, too. 4 straight quarters of positive free cash flow. They pulled in INR 27 crores in Q2, even while spending on land for a new factory.
That's solid discipline. Definitely doesn't sound like a company just struggling with lost volume. More like managing a transition.
Precisely. A deliberate pivot, which leads us right into that diversification story. That's the engine behind the margin strength.
Right, because looking back, say, a year ago, they were heavily reliant on just one or two sectors, weren't they?
Oh, massively. Aerospace and defense, A&D, was close to 70% of their business. That's a lot of eggs in one basket.
Huge concentration risk. So what does the mix look like now in Q2?
Much, much healthier, as they put it. So aerospace is still significant at 37%.
Okay.
Defense, because of that big order ending, is way down, only 8% now.
Wow, from potentially 70% combined down to just 45% for A&D. That's a huge shift.
It is. And look where the growth compensated. Industrial is now 30% of the business.
30%. Up from what?
Tiny before. The growth there was 256% year over year.
Whoa, okay.
And medtech is now 16%. That grew 114% year over year.
So incredible growth in industrial and medtech is basically offsetting that huge drop in defense.
That's exactly the strategy. They saw the defense cliff coming, and they accelerated diversification into these other high-growth areas. It's active portfolio management, shedding dependency.
And it's not just the industries they serve, right? It's also what they're selling within those industries. That impacts margins, too.
Absolutely critical point. There's a very clear strategic shift towards what they call box build solutions. That segment grew 34% year over year.
Okay, explain box build versus the alternative.
So the traditional core business for many electronics manufacturers is printed circuit board assembly, PCBA, basically making the green boards with all the chips on them.
The components.
Right. Box build is the next step up. It means they assemble the entire product or a major subsystem, put it in its enclosure, the box test it, maybe even load software. It's a much more complete solution.
And why is that better for Cyient DLM? Stickier relationships, better pricing.
Both. It moves them from being just a component supplier, maybe competing heavily on price for PCBAs, to being a deeper manufacturing partner.
Harder to replace.
Much harder. These box builds are usually customized, involve complex testing, maybe managing a whole subassembly supply chain. That integration builds stickiness, and because it's more value-added customized work, they generally have more pricing power and margin potential compared to basic PCBA work.
Got it. So better margins now through mix and box builds. Let's talk about the future then. Section 3, the order book. Because those numbers look pretty eye-popping too.
They really did. If the margin story is about Q2 resilience, the order book is about future confidence. In the first half, H1, their order intake crossed INR 1,000 crores.
Which is how much growth?
A massive 130% year-over-year growth in orders.
130%. Okay, that's serious forward momentum.
It provides incredible visibility. Their book-to-build ratio, basically new orders coming in, versus what they shipped out was 1.6 in Q2.
Meaning they're booking future work much faster than they're completing current work.
Exactly. Their target is just to keep it above 1. So 1.6 is very strong. They expect it to land somewhere around 1.4 to 1.5 for the full year. Still very healthy.
And the type of orders is changing too, right? This ties back to that build to spec, the B2S focus.
Yes. This is what management is really hanging their head on for the long term. B2S is a core part of that huge order intake.
So remind us again, build to spec versus the more traditional build to print.
Okay, think of build to print like this. The customer gives you the exact blueprint, the specs, everything. You just build it exactly as told, usually competing on cost and speed, like a contract manufacturer.
Got it. Follow the recipe.
Right. Build-to-spec B2S is different. It's design-led. Cyient DLM gets involved much earlier, sometimes helping design the product or key parts of it. They bring engineering expertise to the table, not just manufacturing muscle.
So they move from just being a builder to being part of the design team.
In essence, yes. It's a much deeper partnership. They call it design-led engagement.
And the benefit for them?
Huge. It makes them way more valuable to the customer. But critically, because they're involved in the design, they get much more influence over component selection, the supply chain, testing protocols. They can engineer for cost and reliability from the start.
Which should ultimately lead to better, more predictable margins and, again, stickier business.
Exactly. You build that moat around the business. And they've landed some really interesting B2S wins recently that show this strategy in action.
Yeah. Like what?
Well, there's a clear focus on next-gen mobility. They announced a new logo win, a major deal with a Japanese company working on electric vertical takeoff and landing aircraft. eVTOLs.
Wow, like flying taxis? That's cutting edge.
Pretty much. And they also secured a big strategic win with an Indian provider of EV charging solutions, electric vehicles, charging infrastructure. These are long-term growth areas.
And these B2S deals, they're not just short-term projects, are they?
Not at all. That's the point. Management emphasized these are multi-year contracts. That eVTOL program, for instance, runs up to 9 years.
9 years.
And the chairman even mentioned some contracts potentially extending out 20 years. That provides incredible stability, predictability in a pretty volatile industry.
Okay, 20 years is serious long-term thinking.
Okay.
But there's a lag, right? When does the actual revenue from these big B2S wins start flowing significantly?
Ah, yes. That's the crucial point for perspective and, frankly, for patience. The revenue ramp-up on these large, complex B2S projects is slow.
How slow?
Typically, you start seeing meaningful revenue maybe 2 to 3 years after the win.
Yeah.
The really big volume, the bulk manufacturing, might only kick in around FY28 based on their comments.
FY28, so 3 years out, potentially? That feels like a long time to wait, especially after taking that 20% revenue hit now.
It is a gap. They've essentially shed a lot of current lower margin revenue from that defense contract, and the high margin B2S replacement volume won't fully land for a few years.
So how do they bridge that? Are they confident margins can stay strong in the meantime?
That seems to be the bet. They believe the current margin strength, driven by the better mix in industrial and medtech, plus the box build shift in efficiencies, is sustainable enough to carry them through this transition phase.
It's a conscious trade-off then.
Yeah.
Near-term volume for long-term quality and stability.
That's exactly how they frame it. They're investing in that future resilience. Once you're designed into a 9-year eVTOL program, replacing you is incredibly difficult and costly for the customer. That's the sticky, high-margin future they're building towards.
Makes sense. Okay, let's widen the lens a bit. Section 4. Global stuff. Geopolitics, supply chains. How does that fit in? Because even the best contract can hit turbulence.
Absolutely. And for a company with global operations and customers, this is always front and center. They're actively managing these developments.
They specifically mentioned Israel, didn't they? As a key market feeling some pressure.
They did. They were quite direct about it. Management noted the ongoing situation there has had a, quote, significant impact both in the quantum of revenue and predictability of revenue.
Hard to run a smooth supply chain in that environment.
Very difficult. But they also expressed confidence, or at least hope, that stability would return, which would obviously help, given Israel's importance in their high-tech client base.
And beyond specific conflicts, there's the whole trade and tariff situation, especially with the U.S. How are they navigating that? They have U.S. operations now, right?
Yes, the U.S. is critical. Partially thanks to that Alltech acquisition, they have a U.S. footprint. And that's expected to be around 40% of their business this year.
Having factories in the U.S. must help with some of the Made in America push or tariff concerns.
It definitely helps. It provides reassurance for U.S. clients worried about supply chain disruptions or geopolitical risks associated with sourcing only from Asia, for example. It offers an alternative.
But tariffs are still a thing they have to deal with daily.
Oh, constantly. They emphasize they're always evaluating tariff impacts and working on solutions with the customer. They can't really absorb those costs themselves, given the nature of contract manufacturing margins.
So it becomes a negotiation with the customer on how to handle it.
Pretty much. The solutions vary. Sometimes it might involve changing where the final product is shipped to. Other times, maybe routing components through different countries to minimize tariff hits. Or sometimes, frankly, the customer just has to bear the cost until regulations change.
Complex stuff. That U.S. presence seems like a key strategic asset then, offering flexibility.
Definitely a strategic advantage in the current environment.
Okay, so let's try and wrap this all up. We started with this paradox. Revenue down, reported profit way up.
Right, and we saw the profit jump was that one-time accounting gain. Operationally, things were tougher on the volume side due to that defense contract ending.
But the real story seems to be the margin resilience. Holding strong, even improving, thanks to diversification into industrial and medtech, and that shift to more complex box build.
Exactly, the quality of revenue improving significantly.
And then the future view, that massive 130% growth in the order book, heavily driven by these long-term, sticky, design-led B2S contracts, especially in hot areas like EVs and eVTOLs.
Yeah, that's the core pivot. Sacrificing some easy volume now for harder to win, but much more valuable and stable B2S partnerships later.
What's the outlook then, say, for the rest of this fiscal year?
Management sounded pretty positive about the second half H2. They expect sequential growth to pick up, and they anticipate getting back to year-over-year growth starting in Q4.
And the margins.
They expect the margin strengths, driven by that better mix, to continue for the next few quarters as well.
So it really is a picture of a company in conscious transition, shedding lower value work, taking a temporary volume hit, but building a foundation based on diversification and these high-value, long-cycle B2S deals.
That sums it up perfectly. They're playing the long game. Which brings us to maybe a final thought for you, the listener, to consider.
We see this clear strategic shift towards build-to-spec. It promises stability, it promises better margins, but as we discussed, the big payoff, the bulk revenue, is still maybe 3-4 years away, FY28 potentially. So the question is, how does that long gestation cycle for B2S influence how you view the company's risk profile over that medium term? Are you comfortable with the strategy, knowing you need patience for the full financial rewards to materialize? It's really about weighing that near-term volume dip against the long-term strategic value they're building. What's your tolerance for that kind of strategic patience?